In this, we have an example of asset disposal. So we have a truck that in the first case, we're going to sell it for cash. And in the second example, we're going to exchange it. And then at the end of it, we're going to exchange it for a different amount. And so we have this various in our truck. So we have our truck $44,000. It had currently had accumulated depreciation of $24,625. And in our first example, we sold it for $18,250 cash. The very first thing that we have to do is get the book value of that truck. So we have the cost, we're looking at the machine. We have the cost is 44,000. Oh, one too many fours here. And then we have the accumulated depreciation of 24,625. So we have a book value of $19,375. Okay. So we're going to record the journal entry of what happens when we sell that for $18,250 cash. So the first thing that we're going to have is a debit to cash for $18,250. I'm actually going to move that one over so we have a little bit more room for our journal entries. Okay. Then I'm going to insert a couple of rows so we have room to put the full journal entry. Okay. Then we're going to have either a loss or a gain. So you can see here we have a loss because the book value is more than we received cash for it. So we have a loss, and the amount of that loss is the difference between the book value and the amount of cash that we received. Okay. Then we need to remove the piece of equipment from our books. So we're going to debit accumulated depreciation to make sure that we zero out that amount, the 24,625, and we're going to credit our equipment for the entire cost of that equipment. So that is the record for selling at a loss. If we had received more cash than the book value, then we would have had a credit gain. Now we have this $25,000 trade-in allowance is received. And we got a new piece of machinery for $60,200. We need to remove the old machinery. So I'm going to record a journal entry here. I'm going to add a couple of sheet rows so we have room. So first, we got a new piece of equipment, or a new machine. And the value of that machine is $60,200. Okay. This is a gain because 25,000 is more than 19,375. So the gain is a credit entry. So the next debit entry we need is to remove the accumulated depreciation of the old truck. Now we have credits, we have a gain on sale, and that amount is the difference between 25,000 and our current book value. And then we need to remove the old machinery I'll just keep saying equipment, that's fine. At a value of 44,000. And then we have that we paid cash for the difference. Okay, debits have to equal credits. So how much cash did we pay? Well, debits have to equal credits. So let's add together our debits, subtract these two credits, and whatever the difference is what we paid in cash. What happened here? I'm not exactly sure what happened in that equation, but the difference is $35,200. Okay. So now we traded in and we had a $15,000 allowance. So really the only difference here is that now we have a loss instead of a gain. I'm just going to copy this down here. I'm going to change this. We're going to change this because it's a loss on the sale. Okay, so that difference between the 19,375 and the $15,000 trade-in, we had a loss of $4,375. Then the amount of cash we paid is the difference between $6,200 and this $15,000 trade-in, or $45,200 in cash. Okay. In this example, we are going to look at other types of assets, so natural resources and intangible assets. This first example, we have a mine that we has ore for it. So we bought a mine that has 1,525,000 tons of ore. We installed machinery in the mine, and then neither one of them have any salvage value. And we recorded and sell 166,200 tons of ore during the year. So we want the year-end entries to record both the ore deposit depletion and the mining machinery depreciation. Okay, so first we're going to have a depletion expense for the mine. And then we have accumulated depreciation on the mine. So the amount then is calculated by how much we get out of it. So we have the cost of $3,720,000. And we have tons of ore of 1,525,000. Okay, so we get the cost per ton of ore is $244 or $2.44 per ton. We took 166,000 tons, so 166,200 out of the mine for a total cost of $405,528. So the accumulated depletion on the mine is reflective of how much we took out of it with the 166,200 tons. Now we have the depreciation on the machine. and accumulated depreciation machine. Okay, so the information we have about our machine is that it was $213,000, and we want to take it, so our piece of equipment, the cost of $213,500. So the depreciation cost, we take 213,500 divided by the tons of ore. We get a cost of 14 cents per ton for depreciation. So we have 14 cents per ton, and we took out 166,200 tons of ore. Okay. So now let's look at this iron mine. So we have information about the iron mine, and we purchased it on January 1st. We have cost of 60,000 cash to access the mine. It's estimated to hold 100,000 tons of iron. The estimated value of the land after the iron is removed is $20,000. So we want to prepare the January 1st entry to record the cost of the mine, and then the December 31st adjusting entry if 20,000 tons of iron are mined, but only 18,000 tons are sold this first year. So first we purchased the mine, and we paid cash for it. Okay, so we paid $760,000 cash, and then we had additional costs of $60,000. So the total cost of the mine was those two added together at $820,000. The second entry is so that was January 1st when we bought the mine, and now we have December 31, where we have our accumulated depreciation. So we have our depletion expense for the mine. Then we mined more than we sold. So now we have inventory. We have iron in our inventory that we haven't sold yet. And we have the accumulated depletion of the iron mine. Okay. So now we just have to calculate amounts. So the mine, the cost of the mine, 820,000. Then we have tons, 100,000. So the per ton, oh, salvage value. So the cost minus salvage value is 800,000. So we get $8 per ton. So we have, we depleted 20,000. So 8 we sold 18,000. We still have 2,000 in stock. And our accumulated depreciation is 8 times the full 20,000. Okay. We'll finish intangible assets and then revising depreciation